your toes and got you here. Having said that, I thank you all once again for giving us an opportunity of getting all of you under this one roof for a discussion all around taxes during the day. And I would also want to thank people who have joined us online from various locations to be here with us and understand the issues that all of you are facing and what could be the probable responses. I will not want to use the word solutions because the instant solutions in any aspect of tax is not possible at all. You ask a question and you get an answer and it's done. It's not possible. Uh, I want to thank our partners next time. As gold partner, litigation partner, Chalan and Chalan Law Offices, Anantam Legal as law firm partner, Transaction Square as supporting partner, associate partner, VKG Accounting Services. Special thanks to Vidur sir for always agreeing to make himself available if his calendar permits to any of these sessions for which I would have reached out to him. And Pushpendra, I think from the day a few years ago we got connected, I feel myself that I'm growing with you as a professional and following you on various professional platforms and looking at how you are looking at deliberating and sharing your thoughts on various issues are excellent. And I thank you for involving us in that learning path. Rajneesh, thank you very much for agreeing to be here with us and join us during the panel discussion today. Overall, the event is structured in a way, session one will talk about the international tax and transfer pricing issues. For the session, we have with us Vidur Puri, who is a senior partner, SCV & Co. LLP. He is BCom FCA, qualified as a chartered accountant in 1992 and joined erstwhile SP Puri & Co. as a partner in 1992. So with over 3 decades, if my mathematics is right, please Vidur sir, join us on the dais. Thank you very much. On the panel, along with Vidur, we have Maulik Doshi, who's Deputy Managing Director, Transfer Pricing and International Tax at Next Time. He's the Senior Executive Director at Transfer Pricing and the Transaction Advisory Services at Next Time, with an experience of nearly 2 decades. Thanks, Maulik. And when I got to know you're coming here, we started praying to the weather god to give you the Mumbai weather in Delhi. Thank you for joining us here. Thanks. We would like to invite Pushpendra Dixit, who is AVP and Global Tax Head of PVR Group, a qualified chartered accountant, Masters in Law, Cyber Law, Masters in Business Finance, certified international taxation professional. Thanks, Pushpendra. We would also like to invite Rajneesh Verma, Associate Partner, BSR & Co. He is an Associate Partner with the Global Transfer Pricing Services practice and is based in the Delhi NCR location with over a decade and a half years of rich experience in TP consulting. Audience who've joined us online, you have an option of the questions box to type in your questions as and when you have a question, and when we'll pause for an interaction, we will read those questions out to the panel and try to address your queries.
It's a nice day. Maulik joins us from Bombay and Mumbai, and he didn't find this weather very interesting because he has enough rains. But what he missed was his jacket in the morning, and all of us said that yes, we're not used to this October weather, but very pleasant. The weekend wasn't that pleasant. I missed my golf because Saturday, Sunday was entirely washed out. But a great day to be here, and let's warm up today with this session. We'll start with something which is technically for the future, but we'll warm it up for the reason that it's more technical to start with. It's about Pillar 1 and Pillar 2. Whoever has been interacting or understanding how OECD is developing this new mode of possibility of taxation into various jurisdictions cross-country. We've had this experience in India, but what I would do is the way that we will conduct this deliberations would be, I will introduce the topic, get a feel of what we are discussing, pose a few questions to my fellow panelists here. And if there's any question in between, what we would do is between that, we could take one question. If there is, it's very important. Otherwise, at the end of the session, we'll keep some 10 minutes. But to keep it interactive, I'll have the bouncing off of questions. And if there's anybody, one question possibly could be taken up while we are discussing this. So we know about the way the taxation takes place. We also know, so what I'll introduce is the Pillar 1 of the OECD. What the issue is that we have the multinationals who are paying taxes in the home country. we've all grown up with the brick and mortar kind of a structure where the taxation is in the source country if you are carrying on that business, except for some elements of services. Things have changed now. What is being looked at is how do we tax in the source country. We've had these top 100 companies. So there is some sort of a number which was thrown out. I'll just use this in terms of what are the top 100 companies where the revenues globally will be the maximum more than maybe 20 billion, because that is one threshold that global revenue in excess of 20 billion is the trigger for companies to be covered under Pillar 1. So Pillar 1 and Pillar 2 is, as I said, is not here at the moment. OECD is discussing this, but future in 23 or 24, we don't know when we'll see the light of it, but the end of the tunnel is that these companies, so maybe if you look at those 100 companies, when I was doing my research, companies which were in search engines like a Yahoo, social media like a Facebook or an eBay, PayPal. Then we have had the e-commerce company like the Amazon, or IT like the Microsoft or Hewlett-Packard or Oracle, or the companies which are actually manufacturing like an Apple or a Samsung or Sony's. Possibly these are the companies, but when we look at them, there are the companies which could be globally generating revenue, possibly not paying taxes in each jurisdiction because they don't have a presence, or they have enough consumers but not presence through a physical presence. So Pillar 1 is a shift of concept where they're saying that there is a formula being introduced as possibly an amount A and an amount B, wherein some part of the global profits would be allocated to a local jurisdiction where it is being sourced out of. So that's what A and B. I'm not getting into the technicalities, but I'm getting into the whole philosophy about what a Pillar 1 under the OECD framework would look like. Globally, you'll have a taxation of the group. Possibly in one of the countries where there is a source, the tax would be shared. How that will happen is a question which is being deliberated. But given the brief background, at Pillar 1, if I could start interacting with you, then we'll come to Pillar 2. So maybe the first question that I would pose is to Maulik, you can take it up, is when we've had this Pillar 1 in terms of the possibilities of the global taxation, India has already had an experience because how they wanted to tax was possibly through the equalization levy. We are all aware of it. We've also introduced the SAP concept. So what really will be the fate of what we've been introduced in our Indian income tax in terms of the equalization levy, the SAP rules which have been introduced in the domestic law, if and when the Pillar 1 comes in, because that's also giving a formula of taxation. At the moment, India has done unilaterally by taxing. What do you think, and if you can elaborate so that all of us can understand where and how it will merge, please.
Thanks, Vidhu. Good morning, everyone. Good morning, everyone. So, see, essentially, on the Pillar 1 side, I don't think so the overall framework that is getting developed at OECD is to India's liking so much. The threshold turnover of $20 billion, there are hardly a handful of multinationals that get captured in that. And that the thought process of the government was that once Pillar 1 gets introduced, the unilateral measures of SEP or equalization levy will get withdrawn. And they are on record, the finance minister, the revenue secretary, all are on record stating that this is the official position of the government. As per the OECD consensus, the unilateral measures would be withdrawn. My sense is that it will not be so easy, given that now they have tasted what the revenue from these measures are, and the fact that they are actually getting to know what these multinational companies are earning from India. It would not be an easy decision for India to roll back either of them. My sense and gut is that they may roll back to companies where Pillar 1 is applicable. For companies where Pillar 1 is not applicable, they may still continue to be taxed under equalization levy or SEP. In fact, SEP is much more dangerous the way it is worded right now. It goes beyond digital taxation, goes beyond that thing. But that's the sense that Pillar 1, Pillar 2, while the government's position is that they will want to withdraw, sense is they may still continue, and they may also want to kind of see if they can bring a threshold for equalization levy or threshold for SEP in line with what's being discussed in Pillar 1. So if companies are getting covered in Pillar 1, they may exempt it under the equalization levy. But yeah, only time will tell. From a timeline perspective, it's interesting because OECD is committed to 2023 to implement it. We'll have our 2023 budget being announced in February. The 2024 budget probably would be an interim kind of a thing because generally it's just before the general elections. So all major reforms that the government has to do under Pillar 1, Pillar 2 would have to come in the next budget. So hopefully we'll come to know in 6 months, 8 months time what the government's intention to is. At the same time, a lot of changes in the last 2 years in the corporate tax have been outside the budget also. So we don't know what to do, but I think the thought process would be that they will still want to continue equalization levy and SEP till the time the overall thresholds under Pillar 1 are revisited.
Thank you, Maulik. So, India has got one equalization levy, then there is also the digital service tax, the DST in the world. So there also I think the impact will come in because from India point of view it's equalization levy and worldwide it's DST. So maybe that also will be revised. I also remember readings that when we had this issue about equalization levy and the discussion, the US being the one which actually has all the multinationals who will be affected, as you rightly said. The 20 billion may not be the trigger, but they are the ones who are really affected. I think they also had an understanding that going forward, that even if the equalization levy, some taxes are paid, possibly they can get a credit going forward. But these are all terms and conditions which will come out once we do that. Pushpendra, what is your view from the industry? Because we must have somebody from the industry. Have your thoughts as to what could it be, how it is?
Good morning. Thank you very much for each one of you for sparing time. Really appreciate in the raining season also. I agree with you that this recent BEPS thing, like Pillar 1, Pillar 2, is a new attempt by OECD and International Forum to kind of reach consensus on how to kind of tax income where it is sourced, because that's the big thing which is coming up. If we just go a step back and try to understand the basics, it used to be always a dilemma with developing and developed countries. Developed countries always source, put foot down saying that it's a residence-based taxation that should be complied with, whereas developing countries have always been, talking about source-based taxation. Good that this BEPS 2.0 has picked up that thing and drawing a good ratio that source-based taxation is the future or need of the hour. Having said that, unilateral measures were there because BEPS 1.0 could not reach consensus, and there was rampant increase in digital service taxation regardless of the place where one entity is located, but it is present everywhere through the technology, and it has become imperative for all the government or the countries, sovereign countries, to make sure their tax pie is intact, and that led to this equalization levy, or very interesting, significant economic presence which Vidu sir talked about, very comprehensive concept which has been brought into Income Tax Act, which is very, very comprehensive. In fact, anything under the sun can be covered under SEP if one were to really interpret it. Coming back to unilateral measures versus the OECD thing, I agree with the Maulik comment that it will be a thing to be seen how the two things will dovetail. To my mind, the high threshold of 20 billion or that 750 million, etc., of Pillar 1 and Pillar 2, they're too high. They don't actually encapsulate all the companies or the revenue. Developing countries like India and others don't want to miss on their tax pie, and they cannot afford to lose their tax. Maybe they will have to, marry the threshold one way or the other, but we'll have, interesting time till the time a consensus reaches, is my view.
Thank you, Pushpendra. So Rajneesh, to you, and if we can just elaborate further, because as we looked at the companies, and I just mentioned a few companies like the Amazons of the world, there were maybe only 100 coming in the 20 billion euro category. So as both of our friends have said that really 20 billion will capture only 100 companies, and possibly they would have a whatever the footprint in India would be only for those 100 companies. What would be the tax department or your view that would India push, because India is, although how much say it has, but other countries, would they push for lowering the threshold? It looks good from the jurisdiction like India, but if you look at the superpower US, they would not like to let go their numbers. So what are your views, Rajneesh?
Thanks, Vidur. So my take here is that, as you very rightly pointed out, handful of companies are getting qualified on the existing 20 billion threshold. At some forum, the Indian Revenue also has proposed that the reduction in the threshold should be down to USD 1 billion. Now, even if you look at USD 1 billion and convert it into INR, it is something around 8,000 crores, right? Even applying a threshold of 8,000 crores from a developing jurisdiction like India standpoint, you still may not have a significant chunk of companies getting into that scanner, and therefore to that extent, if you compare it with any local measure, for example, equalization levy, I think the threshold is hardly 200,000 INR.
Yeah.
And the kind of taxes the government is able to collect based on these local measures are substantially higher vis-a-vis a computation that they are doing even when the threshold gets reduced to a 1 billion kind of number. So, as Maulik mentioned, we were earlier discussing it on a lighter note, but it actually may boil down to a situation where the government may take a position that, okay, even if the threshold is 1 billion, the companies which are falling in that threshold and the pillar 1 applies, we will leave those out, we will not touch them, but the local measures like equalization levy may continue for the rest of the world or the rest of the community. So it is again a wait and watch, time will tell, but the expectation clearly not is that the government will easily lose out and cease to implement the local measures when the pillar 1 gets implemented.
Thank you, Rajni. That's a very interesting note, and to say that even if it comes in, then the rest will continue. So this is the morning wake-up coffee for you on a technical part. Let's go into the pillar 2. Again, a very theoretical, but it's important for us to discuss, because for all tax practitioners or for the ones who are in the industry, we need to be ready and geared up for future. The other pillar 2 is more theoretical for India purposes, but I will just introduce what pillar 2 talks about, the way that the jurisdiction taxes will be. That worldwide they are saying there must be minimum tax hold threshold for the entities to pay taxes, which they propose is say 15%. Again, there is a formula which is being worked out, and they say any jurisdiction you go to must have a minimum tax of 15%. That means I or an eBay of the world cannot go, or maybe the Google of the world cannot sit in Ireland and pay no taxes, and when they come to countries like India, they're paying high taxes, and then you hide and move around in various tax jurisdictions. So 15% is a kind of a threshold which is being discussed. Now, that's an effective tax rate. They've also got into a minimum source rate kind of a tax, which India normally has. So I don't see India being really affected by this pillar 2 directly, but we have a voice, so that's why India has a voice, and that's why it's being debated and discussed. I had a personal experience which I did when I went to Singapore, for example. The country is small, very, very well regulated. When you get into that country, I'm not talking about the tax part of it, you get into the country, it takes only 15 minutes to clear your immigration. No crime, no nothing, no chewing gum, I mean that's a lighter note, but it's so well regulated. Why would a company anywhere in the world like to go to Singapore? Presently, they would like to go to Singapore because the tax rate is very low. So when these debates were going on, I remember reading somewhere in IFA conference was that countries like Singapore will really build up their system to say, you come to my country, not necessarily to plan your taxes, but your benefit could be even for protection of your IP. They're very strong on the intellectual property. So that they will give you other fringe benefits. So it's not only the drive will be only a tax percentage. So that's what the countries are going to wake up and get ready for. Now looking at India, I'll ask the question here. if giving that background on a theoretical note, once we already have 15%, and Maulik, I'll ask you this question to start with. Since India already has an effective tax rate which is higher than 15%, we all know domestic rates are much higher in that. MAT rate is even higher. So does it really impact India by Pillar 2, and what will be the impact of the, so that is one part of it. On a technical part, if I have a company, the rate of tax is say a higher rate above 30 plus 40, whatever the rate comes in effectively. But through incentives, if I have a lot of incentives, my tax rate comes to less than 15%. So do you think India and how India will be impacted by this minimum bench of 15%, and whether by using these thresholds of tax incentives, if they come down, what is your view, how India will take it? So could you elaborate on that, please?
So Vidut, on the second part, which is the incentive, etc., those companies would definitely be impacted. So if there is a foreign company having operations in India, and if the effective tax rate is below 15% because of incentives, either SEZ, or more recently the spate of incentives are announced for ISFC, right? So there is tax exemption, etc. So for those companies, there would be definitely a kind of a issue, because they will have to either pay a domestic top-up tax in India if India introduces that. So despite giving exemption to IFFC, if further India introduces a domestic top-up tax for those companies, they'll have to kind of make effective tax rate of 15% in India, or they'll have to pay it back in the home country. So those companies definitely would be impacted. There is actually a very complex and a lengthy calculation in terms of deriving the effective tax rate. In fact, some of the CEOs, CFOs in the world have gone on to say that we'll need an army of accountants to actually calculate the effective tax rate. So keeping aside that topic of how to calculate that effective tax rate, if it actually falls below 15%, the tax would have to be coughed up based on Pillar 2 provisions. So it as such does not impact so much of foreign companies coming to India with their kind of taxation in India. But yes, a lot of Indian companies who have gone abroad and who kind of done acquisitions abroad, generally we have seen either using UAE, Mauritius, Netherlands, those as the base in terms of making foreign acquisitions. So those outbound companies would definitely get impacted if the local country, say UAE, for now UAE is also introducing corporate tax, but they are still talking about 9%. Right? So if there is a 6% differential, either UAE again introduces an additional top-up tax, or they'll have to pay the additional tax here in India. So India outbound would be much kind of worthy seeing, because most of the outbound investments have gone through either of the three jurisdictions that I mentioned. So that is one thing which we need to kind of look out for.
No, very well said. Pushpendra, your views, if you can elaborate, then I'll come to Rajneesh to look at his view in terms of the outbound, what Maulik had mentioned.
Yeah, I mean, I agree with that, because India has that SEZ thing still going on, and also if we gather from the past statement of finance ministers, India is also in a way phasing out all those incentivization, so that the tax rate is brought to like 20% or so. So I agree, it will be affecting more towards outbound thing. When India is investing outside India in the countries where tax rate is low, because incentivization of going to a less tax or no tax country is one of the thing. So there they have to pay the top-up tax to make up the 15% thing. That will really get affected. Yeah.
Rajneesh, your views, because yes, I think what we are sort of have a consensus here is to say that India inbound really will not be affected because we have a rate higher, but if I am an Indian or a company who wants to invest overseas for an operating company and normally go through a Netherlands route, so where is the load, your views on this?
So Vidur, I agree with what Maulik mentioned about India outbound. What is happening in this space is that, for example, since the time GAR has been introduced, you would have seen that a lot of lower tax jurisdictions related with holding structures, even in those, India headquartered companies have started creating a lot of substance. Ultimately, the intent of whether you talk about globe rules or GAR or various other BEPS provisions is to make sure that equalized or equitable rights to tax in the source countries is available to the jurisdictions. And I think somewhere I believe that all of these measures collectively converge when it comes to taking the benefit of parking profits in low tax jurisdictions. That is something which will go away, and to that extent the Indian headquartered companies are coming to terms. They are already realizing that either they need to get the holding structures simplified, or even if there are jurisdictions where they believe that they will continue to take that benefit ultimately till the time implementation comes in, they need to start beefing up those jurisdictions in terms of performing significant people functions there, creating substance there in terms of head and brain of the overseas markets, etc.
Yeah, thank you.
Just one point that what I find interesting and what I'm looking forward to is how would India implement this pillar 2 under a domestic regulation, right? Because what OECD says that, okay, you need to bring your statute in line with the pillar 2, which means introduce clauses or provisions for minimum tax rate, top-up tax, etc. Now, typically India has always the tendency to Indianize things when they start drafting the law, which is what my fear mainly is. It would create a chaos situation because sometimes unintended wordings or the law will be drafted in a manner where some of the obvious provisions or somewhere we believe that, okay, pillar 2 actually does not apply. Maybe India will have the right technically to claim top-up tax out of that. So implementation of pillar 2 under the domestic law is something which we need to look out for, and that's the most fearful aspect, because how would India, are they going to adopt as it is the wordings of the OECD or not? That's something which you should watch out for.
Yeah, good point. So till now we've discussed what could be the future. Now I'll give you a bouncer because we have an India or South Africa match starting 1 o'clock today at Firozshah Kotla. So which is the next topic for us to discuss, which is live in a way, I would say, is we're talking about some withholding tax provisions, and we'll start with dividend, for example. Why I said is a bouncer for the reason that India, we said, has unilaterally done and taken some steps, or we just discussed. The next, what we're discussing about is withholding tax requirement for India versus a treaty country. Now, we know that we have treaty countries, and there are rate of taxes generally which is 10% of withholding of a dividend that you pay out to. We've had this concept of MFN, so most favorable nation or a favorable clause that comes in and kicks in. Interestingly, what had happened in the recent past was that India has a 10% tax rate of dividend being paid by an Indian entity to its parent company. Companies residing out of Switzerland, France, and I mean these are 2 and 3, if I could recollect, which has also been in news recently, is Netherlands. So these 3 countries have a 10% rate of tax. We have a treaty, and under the treaty protocol, the protocol mentions that if subsequently there is a third country which is a part of the OECD, has a more favorable rate of tax, in this case being dividend, then automatically, the word is whether automatically or not, that's the question that I'll be posing to my panelist here, the rate of tax would be reduced. What happened subsequently after these treaties at 10%, we had treaties in Colombia, we had treaties in Slovenia and Lithuania. These countries became part of OECD, and the rate of tax of withholding was 5%. Okay. Now what happens? Now these countries which I initially mentioned were Switzerland, Netherlands, and third one was Lithuania. No, the one which higher rates were
France, Netherlands, and
correct. So they have the 10%. Now unilaterally in that countries they announced that now we have OECD countries, these 3 countries, and our rate of tax should be 5% on withholding. Great. This issue came up in India in the tax court. Delhi High Court interestingly held, because there are questions that will come in, whether the time of this country, OECD countries, was when we had the treaty. Did they convert into OECD later? Did this 5% came in later? Was it an afterthought? Does the protocol mention that it becomes automatically? I use the word automatically. Does it become automatically, or does it have to be by way of a notification that, hey, now 10% is reduced to 5%. These questions came up in Delhi High Court. And interestingly, in Delhi High Court, what they held was, this was in the case of concentrics. Sometime in December 21 or the time that it was, they held, yes, 5% is applicable as a reduced rate. Now comes the bouncer. CBDT came out with a notification in February 2022, sometime in 3rd February 2022, saying, no, these benefits are not applicable to these 3 countries because for various reasons. And some of the reasons were that all the 3 countries that we talked about, Lithuania, Slovenia, and Colombia, were either not part of the OECD at the time when we had our treaty with the original countries, or there were other conditions. And they said, no, this is not applicable. Now see the situation where we already have something in the treaty. The other country says it is applicable, India says it doesn't applicable. My question now to the panelists, if you've got the background right, because it was interesting and I thought that we will take it up in terms of the dividend being taxed. So Maulik, I'll start with you. Now looking at the High Court judgment which was there, which is pending in Supreme Court, I know they had in detail discussed about this. CBDT coming out with this unilateral circular saying 5% is not applicable. We have a lot of business with France and the other countries. What would be the position now? And do you think it's fair? I don't know if it's the right answer to ask you whether it's fair or not. What do you perceive and what do you see of this situation? I hope everybody is clear on the issue, so we move on with this. Yes.
So we all know that CBDT circulars anyways are not binding on taxpayers, they are binding more on the tax administration. So to that extent, yes, the one can easily say that CBDT circulars are not binding on me. The question in terms of the fairness of the CBDT circular, I think there are 2 aspects of the CBDT circular. One is with respect to clarifying whether the 5% rate would become applicable to the countries such as France, Switzerland and those countries based on the treaties with Lithuania, which became an OECD member afterwards. So there is a CBDT view on that, saying that they should not be eligible for the 5% because they were not the member of OECD when the original treaty was signed. Okay, there could be a difference of view, etc. My limited point is that the clarification from all the overseas countries, France, etc., came in 2012. Right? You had all 10 years to go back to the countries, discuss with them, renegotiate, or at least come out with your own clarification either before that or at least in 2020 when you introduced your dividend taxation. You actually waited for the taxpayer and the whole litigation chain to kind of go through it, and now you're, after the Delhi High Court in favor of taxpayer, now coming out with the CBDT circular. So that I feel is very unfair on the taxpayers because you're not providing certainty, and a taxpayer is taking a position based on a decree of a foreign country. It's not that I'm putting it out only on my opinion, etc. It's a decree of a foreign country. Then to go back and say that this is not the right thing to do, I think it's unfair on the part of CBDT, or at least on that part. And the second part of the circular, which talks about that no MFN clause automatically applies and they have to be notified, I think that's clearly beyond the treaty wordings itself, because most of the treaties talk about automatic application except maybe Switzerland where it was supposed to be notified separately. Right? So I think to that extent the circular is going beyond what the treaty provides and going beyond what possibly both the countries wanted at that point in time when the rate was negotiated. The reasons for India extending that 5% rates to those countries is unknown. We kind of, for whatever reasons, actually you went ahead and extended those rates. Now to go back on those rates is, I think, unfair on that part. Anyways, the Supreme Court is seized of the matter. Hopefully the next week the hearing takes place and we can come to know what's the way forward on that.
Thank you. So Pushpendra, to you, for the reason that, see, everybody is looking for certainty. Maulik also mentioned about being certain. Whether we talked about in the first half an hour about Pillar 1 or Pillar 2, or we talking about this, any taxpayer would want to have a certainty. Now, by this, there is an uncertainty created. What is your view or the industry's view from generally what has happened in this, and just on a technical part, please?
No, that is really very interesting, and this is something as an industry or as taxpayer we want to avoid. We really do not want to read between the lines, especially where it is not required. Because Maulik rightly mentioned, treaty is a sovereign document signed by 2 sovereign nations after much negotiation. It's not overnight. So when two countries, get onto table to sign a tax treaty, it is, always motivated by so many, considerations, not only confined to taxation. So many things are taken into consideration, then it is executed. Now, MFN is something not new. If country has signed, if India has signed with some other country a favorable rate, and MFN is leading us to that advantage, I agree with that. If some clarification is required, it should have been done then and there. Shouldn't be waited for 10 years, 12 years, etc. to create an, to rake up the issue. Especially when we are entering into digital taxation, OECD thing, we have all the more reasons to, get into the correction mode wherever it is required, even if we believe that we should increase the rate and all, because MLI, MLC, all those things are now at doorsteps. Why to rake up the issues which are already settled is the, my take. From industry standpoint, we have been, learning, interpreting treaty. Now dividend has been made taxable in India. That's where we are all concerned that what rate will be applied when we are making payment overseas. Should it be 10% or any other favorable rate between the two countries? So it really doesn't make sense to unsettle the settled position, and CVDT circular I don't think is adding any value, rather creating confusion at the timing, especially when jurisdictional high court has come up with a decision and we are awaiting the apex court to again deliver on that. From industry standpoint, I'll just draw parallel to the same situation. Maybe many participants can connect with me. Giving benefit of treaty to a non-resident, you require certain documents. Your TRC, your Form 10F. If TRC is having some misses, that can be complemented with Form 10F, and your no P thing. And it is clear-cut mentioned in the law, Section 90, gives a benefit that even if the non-resident does not have a PAN in India, if he supplies the requisite documents which I just mentioned, he should be given the benefit of that treaty. Was the position so far until this new online submission of Form 10F, etc. has come up. And just because the technical reason that non-resident has to apply it on the income tax website and he cannot do so without applying PAN in India is again, making this whole situation cumbersome. Law says that he is not required to take PAN in India for the purpose of benefit of treaty. But by virtue of online this mode, he is mandated to do that. So again, it's a dilemma. So we should avoid these kind of things as a tax, as a country which wants to give stability to the taxation, especially when we are entering into digital mode. Yeah, thanks.
Yeah, right, Pushpender. I think you've touched upon the next question that I was about to ask you. That's why I call this one was a bouncer, because when you have a bouncer, you don't know whether to play it or not to play it. So whether you follow the CBTT rule or you don't, it's anybody's guess. But coming to the next question and the next topic, one was the dividend part of it. The next hot topic for anybody would be when we reimburse expenses, so what we call the fees for technical services. When in India, reimburses or pays an amount to an overseas entity, very clear if it is in the nature of services, then there is a withholding tax trigger, and if they have a PE, then the other implication of an Article 7, etc. But now what we are talking about is when we have a simple transaction with possibly an outside entity which is pure reimbursement of expenses, would there be a withholding tax requirement? I think all of us every day read about it and discuss about it, and that's where your confusion, which you rightly said, is that when I have somebody overseas, they don't have any business in India. You are required to have this 10Fs that you started talking about over a practical part. But generally, what is the view, Pushpender, in terms of reimbursement of expenses from your side? Then I'll ask the technical question to our professional panelist here.
So this reimbursement thing is really troubling. Ever since I started career in tax, it is not settled fully. I believe someday we reach to a consensus. Although the technical part is very clear that if there is an element of income in the underlying transaction, it should be subjected to tax. Is as simple as that. But now, how to make sure that underlying transaction being talked about is pure reimbursement or it's a camouflage? A transaction which should have subjected to TDS. For example, if my overseas subsidiary is incurring some consultancy expenditure, or they are engaging some auditor or some professional agency on my behest and making them payment and asking a reimbursement to me from India, what would I call it? Is it just a reimbursement? Is question number one. Question number two, some local registration required for a branch. Some third agency is doing it on my behest and clearly, claiming that registration, etc. cost from me. Is the another stark example. So just to keep it short and crisp, in first example, we have a plumb line of checking if the first transaction I had undertaken myself would have subjected to TDS. Hiring a technical agent or professional service obviously will be in the nature of professional service. Just because it has happened through my subsidiary or other branch, I cannot treat it just a pure reimbursement. Whereas the latter one, which is just a supporting thing, which does not involve any skill, etc., is a purely reimbursement. That's how we demarcate. But needless to say, still authorities of different places, they try to read between the lines. And why to go far away? This 194R is new creation, and reimbursement is one thing especially talked about it, and we have to find a way in that also.
Yeah. Maulik, your view, because as we said that reimbursement, whether it has an income element or not, I'll ask the same question later to Rajneesh and move on, but your view in terms of what the industry perceives and how very good examples that Pushpendra gave was and kind of an agent who does that third party expenditure, and we move on, but what is the view of the profession here?
So pretty much echo what Pushpendra mentioned, that you have to see the underlying transaction. Just because it's being routed through a associated enterprise or a related party of yours doesn't change the underlying transaction nature. And if the underlying transaction was supposed to be taxable, routing it through another company is just kind of giving it a color of reimbursement and then trying to kind of avoid taxes on that. So you have to see the underlying transaction, accordingly decide the withholding or the taxability of this thing. The interesting question also is that who decides whether there is an income underlying or not.
I was wanting to hear that.
We are saying, we always say that, okay, if there is no underlying income, section 195 says it should be taxable, only if there is a taxable income we should deduct. But who decides? As taxpayers or as chartered accountants issuing 15 CSE be in a position to decide that? Or it should be given an opportunity at least for the AO to examine if there is underlying no taxability, etc., the foreign company can always claim a refund of those things. So that's also important. Sometimes we really step into the shoes of the tax officer, decide that ourselves and kind of close the transaction. So this is what we need to be slightly careful looking at the underlying transaction. But otherwise, for pure agent reimbursements, they will introduce that concept in 194R, which is going to further confuse things itself. But the pure agent reimbursement possibly would be outside the withholding tax limit.
Yeah, very well said, because I wanted to hear that 195 and the 197, whether we have the right to really give that certificate, or is the assessing officer to do that, and where is the threshold or the way to start with. Now we've had a bouncer. I'll throw a yorker to Rajneesh. Rajneesh, reimbursement of expenses also can be in the nature of employee expenditure being reimbursed to the parent. I'll give you an example, and the question is where I have a parent company which has employees. They have a subsidiary in India. They send their technical person who becomes my managing director of the Indian company. Now he draws salary in India. He's taxable in India, there's no doubt about it, but for the reasons that he has a social security lien or benefit which continues in the parent company, we would reimburse certain expenses or part of his salary because of administrative purposes. He may be drawing part of it, I'll reimburse that. The question now to you is, what would be the nature of these reimbursements, whether they are really taxable under technical services or the entire salary remains as 192? Also looking into the fact, now we had a very recent judgment in the case of GST, in this case of Northern Operating Systems, Supreme Court. We are all aware of it, where they've said that it is in the nature of services. Will that impact in the taxation under the Income Tax Act, especially when post this being tested in the last so many years, secondment is an agreed term, lien is shifted, etc., etc. I'm sure there are a lot of questions being asked. Rajneesh, the yorker is on you. Let's see how you handle this now.
So, Vidur, we have been discussing, increased mental interpretations both from the taxpayer community as well as from the revenue side. We have been discussing at different points in time, different measures are introduced by the revenue. And while originally the intention is to reduce the complexity around taxes, whichever way they are present, but ultimately what happens is that there are so many additional peripheral issues that come up with the introduction of those measures that yet again another battle starts between the taxpayer and the revenue in terms of what way it is to be interpreted. Now, we have always, been believing that the court system in India, whenever we have a ruling from the High Court and for that matter Supreme Court, that typically puts to rest all these different interpretations and disputes that are going on. But this is a classic example that you talked about, northern operating, where while from a GST standpoint, it makes it clear that any secondments in India for these expatriate employees are service. Historically, you would see that from a corporate tax and transfer pricing standpoint, mostly taxpayers have been taking a position that these are nothing but the reimbursement of the expat salaries to the overseas people. And while from a personal taxation perspective, on an individual taxation, the entire salary, including perquisites, are taxed for that individual in India. But for the purposes of reporting and recording from a corporate standpoint, the position has always been that these are reimbursements. Now, this is exactly something which we were discussing before you introduced northern operating, that whether the underlying transaction is a character of income for the foreign company, whether the underlying transaction is a service element or not. Now, just because from a GST standpoint, it has been made clear by the Supreme Court that this is something which has to be treated as a service, there are again in the direct tax and transfer pricing corridors, a lot of noise is getting created as to whether the companies need to change their position, whether till now when from a transfer pricing perspective they have been characterizing it as a reimbursement, does that need to take a re-character of a service? If it is to take a re-character of a service, should the foreign company be actually charging a markup on top of the expenses that they have incurred on behalf of the Indian company? And then various other relevant issues that are cropping up. So far what we have seen and observed and talked to the industry practitioners is that in GST, if this is something which has been introduced as a service, and this is a classic example where the reimbursement comes into play, the people are trying to take a view that is consistent with what they have taken in the past from a direct tax and transfer pricing standpoint, that the taxability does not come into play. They still want to continue to treat it as more of a reimbursement, and ultimately the test lies in the underlying documentation that the companies are maintaining.
That's nice, because at least we have some sort of a clarity what we hear from the other side. Maulik, is there any other view for this? Because what I hear is all of us have again the idea that what is the underlying transaction and no element of cost, etc. But after Northern Lights, again specifically on this issue about salary.
So after Northern Lights, obviously the case law, the Supreme Court law, case law is in the context of GST, right? How much can we extend it to withholding tax? Possibly another Supreme Court ruling only will tell. Because we have several High Court and other judgments which have said that this is, the economic employment is with Indian company. What Indian company is paying is pure reimbursement. Even after Northern Lights, I think there's a Bangalore tribunal ruling on that, right? Say that this is pure reimbursement and there should not be any withholding tax on that. So with due respect to the Northern Lights judgment, we actually need to test the terms of secondment in terms of whether it's a service being rendered. Because even in Northern Lights, I think somewhere there was a reference to Morgan Stanley Supreme Court ruling, which was in the context of service fee. Now, if the service fee was invoked and saying that this is a service being rendered by the foreign company, then I don't understand whether it should be a manpower supply or a technical service. Right. Because then technically it's a technical service that the foreign company is rendering through that employee, and therefore there should be the head of the GST should be possibly under technical services and not manpower supply. But my personal still view is that if it's the economic employment is with the Indian company, irrespective of the fact that with the Supreme Court ruling, the withholding tax liability should not trigger. And if we go by the Supreme Court ruling, look at the scenario that would get created. I'm taking a case of a foreign company having an Indian captive service provider subsidiary, which is getting remunerated on a cost plus basis, right? If we go by the Supreme Court ruling, Indian company should have deducted withholding tax on the payment made to foreign company. Foreign company should have charged a markup on the employee reimbursement portion. Indian company's P&L account would get with the markup and again go back with a cost plus markup back to the foreign company. So this kind of scenario it will get created would be a kind of a chaos thing. But that's where I think we need to draw a line between the GST ruling and what positions we adopt in withholding tax and transfer pricing from our perspective.
Thank you, and both of you played the Yorker very well. So, but any questions here? Because then we'll move on. Yeah, sure. One question, as I said.
My concern is regarding this online filing of Form 10F. How are you managing that? You're asking your non-resident vendors to take PAN in India, or
You threw it and it gets back to you.
Yeah, your good name? Rohit. Yeah, Rohit, I can share my experience with you because there is no common consensus reached yet. But the position is that we need clarification. And to my mind, it's a short-lived situation. The substantive law cannot be bypassed because of the procedural or thing is the underlying idea. We are just, since TDS is a very onerous thing, we do not want to take chance. For all new vendors, we are asking them kindly apply PAN or we'll withhold higher rate of TDS as if you don't have PAN in India. That is what we are resorting to currently. But if we know that we have long-term vendors which are regular with us, we are requesting them to apply PAN for the time being. But this is not easy. Easy said than done.
Yeah.
They are not easy digesting it. In fact, just look at it from the non-resident standpoint. Why would somebody take local ID in India just because a procedural change has come but law does not mandate? So it's a really tricky situation, and we get a pushback also.
and they will fall under other compliances also?
Yes, but for foreign, for royalty and FTS, etc., there is immunity from filing return, etc., in India. So to that extent, still there is some respite, but situation is really tricky. It's not easy.
Can I present a completely opposite view, 180 degree on this 10F?
Sure.
Because I've been debating and discussing this with many corporates. Section 115A, which is the provision for where the trigger for foreign company filing tax return and exemption comes into picture. Section 139 says you need to file a tax return if you're earning income from India. 115 provides an exemption. That exemption is available only if the withholding tax is done as per the Indian Income Tax Act, not as per the tax treaty, right? So the intention of the government is clear that if you are claiming treaty benefit, please file a tax return, because as tax authorities, we want to examine whether you are rightly claiming the tax treaty benefit or not. Under Income Tax Act, we can give you the exemption from filing tax return. Now, if they have to file, if TRC 10F is required for availing treaty benefit, and if the taxability is under the treaty, and if they have to file a tax return, anyways they have to apply for PAN. If that anyways the permanent account number is required, the 10F is an electronic mechanism to submit this thing. So at least with respect to royalty, FTS, interest, those three elements where they are earning income from India, according to me, the requirement for return filing as well as requirement for having a permanent account number and therefore 10F electronically is there legally, supported by law. There are other cases where this may not be required. To that extent, yes, I understand there is a kind of the requirement of online filing just by a notification is going beyond the law, but at least with respect to this, there is a requirement. So I think it's more education to the foreign investor also, saying that, yeah, you are earning income from India, you are taking a treaty benefit, the Indian government has a right to check that, and therefore you need to file a tax return in India, and therefore this is a procedural requirement.
Well, I think we should make some noise because before it goes in, the industry should take it up with the chambers, because this is a technical issue, not only FTS, it's also about reimbursements or the suppliers. I mean,
Correct.
Why would you want somebody to do that?
Correct.
Technical,
Correct.
that's
where we are saying we are withholding as per Act, which is 20%. So it's a temporary punishment, I would say, which is not warranted just because we can't, take taxation or TDS non-conservatively. We are just saying that better we should deduct higher to avoid any litigation thing. But not a good position for overseas investors. It should be rectified soon is what I request.
Even in case we have already taken the physical form 10F, we need to ask them to do it online now for financial 2023 also.
No, so now the non-resident has to log in to income tax website, upload the form 10F TRC, and then there will be an acknowledgement that will get generated, which you need to share with us or the payer.
If a physical form is before 13th August date, the notification came in the online, etc., then I think it should be valid. I don't think so. Then you require a 10F again for 22-23.
People may also take position that 10 आ जाएगा जब तक वही rate कर लेते हैं and all, but we don't subscribe to that because TDS is onerous subject and penalty and all those things are there. One should be really very conservative in terms of TDS provisions is my experience.
You have a question? I'll take the second one. Oh, you got more than one question? Okay. We'll keep it quick because otherwise we won't be able to finish, but it's a quick one, Ken, both of you, yeah. Do you want, yeah, okay, you just, no, yeah, it's okay. Yeah.
Hi, my name is Geetika Chavla, and as Vidhu said that I'm also working in a company in which employee being engaged all over the globe, and the billing is raised at the year end in internal billing for the employee support they provide all over the world. Like from India, we have employees who provide their technical support in other countries and vice versa. But during the internal billing at the year end, when they raise invoice to Indian subsidiary, our parent company is Denmark based. So when they raise the year-end billing, it's inclusive of all the expenses, overheads incurred by the headquarters. It inclusive of employee support, is it a software which runs all over across the company, everything. So at the year-end when we get this bill, just booking the bill in our system as per Indian standards, we need to pay on provisionary basis as well the taxes, which is actually the cash outflow for the company, even if we are not paying the actual payment to the headquarters. So it is actually making the burden on the name of taxes, be it on withholding tax on payment to foreign company as our headquarters, and also on the name of a GST reverse charge as well. It's an outflow of the funds as well. So parent company based in Denmark especially, they find it India or Asia that more of a compliance, more of a cash outflow, even if we are not making any payment to them against their internal billing.
So, I didn't get your name, sorry?
Geetika.
Geetika. Geetika, we can discuss this post-lunch, but quick revert to you. Payment does not mean that there is no trigger of tax, that's number one. Overseas companies have to get ready to pay and understand what India is all about. Question number three, related to how they're going to charge. I have a question which I framed, which will come in terms of A, the TDS, and B, transfer pricing. I think that is a very important part. I've covered that in the one, in next 10 minutes you'll have that question. I hope you'll have a clarity on that. Otherwise, during the break, you're most welcome to speak to me, but I've sort of covered that. But to answer the trigger will happen, just because you're not making a payment. Your question and then, yeah.
We have one question online as well.
Okay, you want to take it up now again?
Wherever you want. While concluding, you can take that.
No? Yeah, we can take it up now. Great, because at least there is an interaction. Yeah, I'll come back to you for sure. I'm glad you're asking the question. The Yorker and the bouncers affected everybody. Good.
Okay. Hello.
The gentleman is from?
Yeah. Okay. So there's a lady, Priya Sharma. She has a question. So she says when we talk about the Northern Line SC case, that the test lies with underlying document. In that case, what we should actually see in the documents, and there's a second part to it. So the companies normally have secondment agreements in place. What modifications should there in existing agreements?
I'll have this question to Rajneesh, but with the caveat that there's no professional advice being given by any of us, because this has traveled quite a bit in terms of what the documentation must speak and what it is. And as Maulik has said, Northern Lights has confused everybody. but the nature will not change. Rajneesh, to you, and I think it's a question that we've all been deliberating. Yes, please.
No, I think a very short one on this is that ultimately what you need to look at is whether it takes the true character of what the kind of payment that you are making. Is it purely for the administrative convenience that the overseas entity has incurred on your behalf and therefore you are just paying it out? Or you are in a position where you've actually received service and that can ultimately convert that payment into an income character for the overseas company. So I think again it comes back to creating that litmus test for the nature of payment that you're making, and when it comes to whether having the right clauses in the agreement or having the right documentation, I think both the answer lies in creating a very clear trail for you to be able to establish before any authorities. We have had a recent case where the assessing officer did not really touch upon that expense and gave a clean sheet to the taxpayer, but when for other issues, when the taxpayer went to the DRP, because of the reason that the DRP has the power to enhance, DRP picked up that same expense and treated it as FTS and enhanced the adjustment. So why that happened? Because of the reason that the underlying documentation may have been weak, or the relevant clauses in the agreement may not have supported the position that the taxpayer may have taken.
So that lien and the hire and fire, that principles have to be enshrined in the contracts. I think that Indian has. Your question, and then we'll move on to the next one, please.
My question was related to transfer pricing. So,
if it's transfer pricing, we'll wait for 5 minutes, because I'm going to cover transfer pricing. Yeah, and that question, because I want those questions answered and questioned also. Yeah, for sure. Because TP is the next, after this we'll pick up TP related to this, for sure. So the next one, I'm glad everybody's woken up and we've had this question, is also a very typical question on royalty. Because the next one comes in terms of when we have these payments which are being made to overseas companies, whether they are in the nature of royalty or not. So we've had this Supreme Court judgment which clearly defines the engineering analysis. There were a bunch of others where it was defined what is a shrink wrap software, whether it's subject to royalty, whether it's subject to TDS under the Income Tax Act. And suppose there was an amendment in 2012 which was retrospective. I think the Supreme Court really covered that even if though the definition has been amended in the Income Tax Act, what is royalty, it will not go back to 1976. But post 2012, there is a clarity, but you still have benefits of the treaty. Now the question to you, Rajneesh, we'll start with this, is that given this elaborate judgment of the Supreme Court, and there is an amendment in section 916, explanation 4, which is retrospective since 1976, I understand there will be no impact. Is that what it is, and how would people look at royalty now vis-a-vis the Act as well as the treaty on these software payments?
So at least from a taxpayer standpoint, I think we are seeing more and more cases where they are trying to align the facts present in the taxpayers' cases with the Supreme Court ruling. While I think there's a review petition still filed by the department, and yes, they continue to take a position that till the time there is a disposal to the review petition, they would not budge and consider this subject to withholding. My take here is that ultimately, like we are talking for each transaction, the difference lies in you are giving the right from a copyright perspective to the licensee, and therefore ultimately the transaction takes the nature of royalty, versus if it is a one-time use, if it is non-transferable, if it is non-exclusive, and I think those are the aspects in which have been touched upon in the Supreme Court ruling. And if you are able to follow those line of argument, and through again the backup supporting documents present the case that this is something which is not a nature of royalty, is the differentiating factor. As far as applying it, retrospectively, broadly the consensus is coming off here is that this is not something that both from a withholding tax standpoint as far as the taxability standpoint itself, you can go back to the past and apply it from day one.
Thanks. Maulik, when we've had this, what is the view? I am sure a lot of people would be having the similar questions, and we all have that on a daily basis. Now, would that have any effect on the kind of payments that we make or the companies make for data access charges or subscriptions which are subscription based? Would that also have an effect, and would that be treated as royalty and continue to be treated as royalty? And an Indian taxpayer, when it does a subscription model, would it be advised to deduct tax, not advised? I mean, what would be the case here?
So strictly speaking, engineering analysis would not apply to the database payments, subscription charges, etc., because it is in the context of pure kind of strict from software, royalty payments, etc. So as such, the Supreme Court ruling won't help over here. There are several treaties where the wordings of the royalty clause includes payment for industrial, scientific, commercial information, right? And in that case, the tax department is trying to kind of say that the payment for subscription charges, database usage, etc., is in the nature of royalty based on these wordings under the definition of royalty. But there are several tribunal judgments which says that these are nothing but just compilation of publicly available information. It's been kind of put in a proper format for people to read, etc. And therefore, no, it strictly is not in the nature of royalty. And if the foreign company does not have a P, there should not be any taxability or a withholding tax on that. So I think those positions will continue to hold good, and the Supreme Court ruling would not have an impact as such on those payments.
Okay, thank you. Pushpendra, any view, and then I'll come to the next hot topic in terms of the transfer pricing.
My take is good that this Apex Court decision of Engineer Analysis Center of Excellence has come. Even before that judgment also we were following the same suit in case of foreign payments with a treaty country. We were just looking at the beneficial royalty definition, which was restricted compared to the domestic tax, which is very well elaborated. I mean, on a lighter side, if you read the royalty definition as per Income Tax Act, even you are boarding a bus, that underlying machinery is running for you. Would it be a royalty? I don't know. But that comprehensive definition is of royalty in Income Tax Act. But I think the matter will come to an end when the Domestic Act will be modified or amended to give effect to the Supreme Court finding. But I agree with the decision. It's a welcome decision because at least with respect to the shrink-wrapped software or copyrighted thing. One is copyright, one is copy of a copyright. So end user license agreements or all those software licenses, etc., which you can use. For example, Tally software. You can take a copy of it. You can use for your business. But do you really have ability to amend it? Do you really have ability to copy it? Do you really have ability to sell it? You don't. So it's a copy of a copyright. To that extent, I agree and welcome this judgment, and it should be enshrined into Act also.
Of exactly your question, where we have an Indian company and there are parents, and the parents push back certain costs because they are doing the work globally. So there is an IT cost, there is a salary, there is an admin, there is a finance, etc., etc. We've had many judgments coming in terms of cost-benefit analysis, whether you actually are getting the benefit in India or not, whether the costs are being pushed to me, whether I need to justify. So looking at the scenario, what we call that intra-group services. Yeah, so we'll have this question on intra-group services where we have these costs coming in. Now the question is that what generally we face, or any taxpayer would face, or a professional would be asked, is 2-3 things. Whether we have such costs coming in, do I need to justify for transfer pricing purposes that I have a benefit for the cost that I am receiving? What would be the justification for this? And as you said, there is always a cost plus overhead, because when you have a salary, it doesn't come in a pure salary of a person sitting and doing some work there. There is a markup, and the markup means that if I'm using that desk is associated with a lot of costs which is there. So there is a formula which all the companies in the world have that, and there is an allocation key. Looking at that, I'll have the questions to you, but I'm giving the background. One is this. Second is, what kind of a documents would I be justifying for my tax authority? Because when we ask this question to your company, for example, you'll ask your Denmark company to give me a justification of what your cost is. Do I ask for an auditor's certificate? Give me a certificate how you allocated that markup. Do I ask for a management certificate? Do I ask for a copy of the ledger? Because my tax officer is ultimately going to say, hey, you asked me that you've charged me €100, but is €100 the right amount? So transfer pricing, documentation, I think these are the questions that I'm assuming you should have asked, apart from the tedious part of it. I'm asking on your behalf because, so this question, Rajneesh, I'll throw to you because you do transfer pricing in and out. Your thoughts, and then I'll come to Maulik post that, is in terms of cost-benefit analysis, does it still hold good? What would be the justification of these global intra-group services? Would an international transfer pricing and allocation key be justified? And third is, what kind of documentation, as I just mentioned, would justify and satisfy the appetite of the assessing officer, the transfer pricing officer, which I need from the parent?
Thanks, Vidur. I think the question is so elaborated that the answer lies in the question, if you're asking. Like other disputes, this intra-group services related dispute also is something which has traveled for more than a decade now in India. And in that sense, while transfer pricing regulations in India may be 2 decades old, but the kind of maturity that the Indian transfer pricing regime has attained, it has actually surpassed a lot of developed jurisdictions also who have introduced transfer pricing regulations perhaps 4 or 5 decades back. As far as intra-group services are concerned, more often than not, you would see that the tax office has 3 or 4 key contentions to cite. One is that this is something which any which way your parent is supposed to do as a shareholder. It's something which is a shareholder service and not something which you should pay for. They say that if you are receiving an HR service or a legal service or a finance service or an IT service, you yourself within your company have an HR department. You have IT employees also sitting in. You have an accounting and finance department as well. And therefore, even if these are the kind of services which are coming in from there, these are actually duplicative services. You already have employees and departments running at full-fledged scale within your company who are capable of performing all of these functions. And therefore, that is the second bigger argument that comes in from the revenue, to say that you are all duplicating, you don't need those services if at all they are coming in. The way we have seen, and as I said that the dispute has been going on for like more than a decade now, even the taxpayers are becoming more and more mature versus a situation that earlier you would simply receive an invoice from the parent company as a tax department within the company, or for that matter an accounting department within the company. You would record that invoice and you would make the payment as per the credit terms. Vis-a-vis, now there is so much of awareness because of this being challenged at such a large scale from the revenue, that the Indian company does ask those relevant and pertinent questions from the service provider even before the invoice comes in, as to how the amount has been arrived at. Is this a cost pooling at the parent's level, and then using certain allocation mechanism, you have allocated this much to India? Are you allocating only to India, or this is something which is going to various other the subsidiaries across the globe? Now, even if there are quantifiable aspects which are presented by the parent, that this is the allocation mechanism that we are following, even the qualitative aspects are equally important, and that is something which I have seen satisfying in some shape and form the field level officers when you present it to them that these are the need benefit documentation that I have received from my parent company. And even if you are not able to satisfy the transfer pricing officer for that matter, at least when the matter travels to the likes of DRP or for that matter tribunal, there it sees the light of the day as long as that need benefit document is presented to the relevant forum. So I think it's not a perfect solution, but the answer really lies in whether whenever you are receiving these services, apart from the intercompany invoice, do you have the right supporting documentation backups to support that you have not only paid that amount as per perhaps a very robust allocation mechanism that the parent has followed, but you have paid that amount against an actual receipt of the service. If you would not have received that service from the parent, you would have perhaps gone out in the local market and scouted for third-party service provider and obtained that service. You would have perhaps developed in-house capabilities, employed relevant people, and performed that service. So the ultimate test, again is whether you are able to demonstrate to the tax authorities that the service was really required by the parent, by the recipient, or it is just that parent is performing certain functions sitting at the top and just allocating charges to the subsidiaries across the globe.
Yeah. Maulik, your view? Then I have this question that was related to, I think, TDS and transfer pricing, but we'll come back to it.
No, so I completely agree with Rajneesh. Two rulings I kind of have learned on management fee which are really important. Both are adverse in that sense. So you really get to know from the adverse rulings what you should not do. One is the Bangalore Tribunal in case of GEMPLUS, where the case what Rajneesh mentioned, there's a single invoice. And based on the single invoice, you are claiming a deduction for management fee from a transfer pricing perspective. I think so no court or authority would allow that. And that's what was happening prior to that, and a lot of education, a lot of awareness is now getting created. And second is the Bombay Tribunal ruling in case of UCB, if I get it correctly, where I think there was the member, the judicial member had kind of mentioned that if your mother parent is not going to help you by not providing you the documents, supportings, workings, etc., we are not here to help you. Right? So I think most the management fee 9.5 points out of 10 will go to documentation. If you are able to have the right documentation in terms of right supportings, benefits, etc., you should be able to get through. Otherwise, it's very difficult, not only in India, but now even overseas, these questions are getting kind of addressed, and these questions are coming saying that is there a benefit, is there a proper allocation key or not?
So in terms of the documentation that I wanted to have an answer was that yes, they will provide us all the documents and justification. What document would that require? An auditor certificate or management certificate giving all the elaboration that this is actually the true cost plus an allocation? Would that be good enough? Or I mean, how would you perceive that?
So we have seen cases where the tax authorities have gone and asked ledger accounts of foreign companies, right? The profit and loss account, and he wants to himself examine. I don't think so. The tax authorities in India has neither the trust on the management nor on the auditor to that extent. But yeah, if you have an auditor certificate certifying, that gives a little bit more comfort. It passes the smell test, and also the comfort to the tax tribunals, etc. When you go to the appeal process, if the tax officer is not satisfied, so an auditor certificate is always there. In terms of benefits, the documentation is critical, right? So in terms of visits, what kind of services are being rendered, what visit reports, if there are people coming down, what kind of presentations, etc. they have provided, etc. That's more critical on that.
Thanks. Do I have answered that, or is there something related to TDS, please? And then we can have Pushpendra. Yeah.
It's something related to round, but it is something different.
Please.
So my question is regarding some intergroup transactions only. So suppose in my case, our global tax advisor has given a transfer pricing policy which says that at the year end, you do the all transactions grouping and allocation and everything, and you decide a margin and you do the difference billing or whatever adjustments are there. Either you receive it or either you pay it.
Correct.
So in India case, it is a payment. Solution. So my question is that at the year end, how the income tax and RBI will permit those transactions?
No, income tax मेले तो it comes to, I'll ask the question here also, I'll react immediately. Is the global transfer pricing policy is in place? I think that's what I hear from you, right? Which means the allocation keys have to be done. There is a purchase or a sale, and based on that you have a marketing or whatever, and then you are allocated a particular percentage. Within that percentage you may have to give or give it to that. If your transfer pricing document is well accepted, right? This is the documentation. Then I understand that this is a general and a normal phenomena. In terms of the Reserve Bank of India, I think Reserve Bank of India will have to have an additional invoice coming in and you'll have to justify that. That's my way. But anything else, then I'll ask Rajneesh to respond then.
In that perspective, I just want to add that margin they decided based on the global profitability or holding company profitability margin. But in India, what we are doing the business, which is having some higher margin. Say they have given us a 10% margin for the intergroup transactions. But for India perspective, what we are billing to local customers and other customers, we have around 20% or 25% margin. So how income tax can ask question why you are taking 10% on the basis of global transfer pricing policy, and the RBI, why I put this question, because RBI has certain types of payment in Form A2 and all. So there is no payment which relates to transfer pricing adjustment related payment.
Correct.
Because we need to put this payment under any
Underlying. So that's the, yeah, it has to be, yeah.
So, and one more point is there, customs regulation. If it is a purchase of goods related things, so then you have custom implications as well. So these are the things where the clarity is not there on paper.
No, the clarity is there, but what is missing is the nature, because what you're saying is that you're allocating profits. Maulik and then Rajneesh, because I have a different thought, but yeah.
No, so his point is relevant to the extent from a purchase of goods perspective is there, because the underlying documentation for purchase of goods, when
Is
you're
there.
going to make the payment, the first payment you are making, it's okay, right? Then you say that, okay, the price has been subsequently revised and you need to make an additional payment. For that, there are issues with bankers because the underlying documentation is not there. So with respect to RBI, to that extent it's practical, but bankers needs to be, and a lot of bankers nowadays, especially foreign banks, are understanding this situation and then allowing the payment, which head under A2 will go under the original head only. It's just that the bankers need to get convinced, and this is because of the transfer pricing adjustment, year-end adjustment that has come, this additional charge or additional receipt, whatever it is there.
But that original payment, suppose it is relating to billing, suppose we have billed something to intergroup transactions, and now they are asking that we have paid you extra as per the transfer pricing regulation, at the year end you need to pay back to us.
Absolutely. So that's actually a discount. You received the payment, you're given a further discount, and therefore you need to pay it back. To that extent, that's possible. You have to convince the banker. I'm not saying it's easy. You'll have to convince the bankers, but we have seen bankers now understanding, at least in last 3 to 5 years, we have seen bankers understanding. Earlier, it was a clear case where it was becoming very, very difficult. The other aspect that you mentioned, that you are comparing your global profitability vis-a-vis your Indian profitability, that is going to be an issue.
Yeah.
Because the tax authorities has a right to question, and you need to justify, if at all, if the difference in pricing and the margin is because of any geographical issue, geographical conditions, etc., saying that, okay, in foreign country that margins are not there, it's a different market than the Indian market, etc. So those commercial and business factors will come into play to distinguish the margins between the two parts.
Rajneesh, I think that's the biggest challenge in a way, because till the time we are able to justify that it is coming to me because of my or my India's benefit or the effort that is being done, but global margin being allocated, I think this is very typical, but what is your view here? It's difficult, but...
So the gentleman has raised very
Yeah.
live and practical issues, and there are two aspects, and I will take up the second one first. See, every day we come across situations where there is a global transfer pricing policy which says that across the globe we are implementing, let's say, something like a cost plus 5%. But for example, when it is an Indian service provider, and we all know that 5%, 8% days are long gone back, in the Indian context, it has now almost become very clear that anything in less than 10% from a service provision perspective is unacceptable and qualifies to be non-arm's length from day one. And that is the biggest difference that is coming about, that until in the local jurisdictions the global transfer pricing policy becomes acceptable, the taxpayer keeps facing challenges from the local revenue authorities in terms of disallowances. And therefore, we keep advising to all the MNEs operating in different jurisdictions to say that whenever you are setting up your global transfer pricing policies, always take into account wherever you are prominently operating, whether that is acceptable to the local laws or not. And it has become very routine now that even if there is a GTPP in place for the foreign group, there are variations jurisdiction wise that they have set off within their global documents, for example master file, that they are living with the fact that there cannot be a consistent global transfer pricing policy followed across the globe, and the variations will arise because of local factors, like Maulik also elaborated. As far as the first issue that you raised is concerned, I think there again, we always orient towards finding solutions and answers to this. And in our practical dealings with such situations, what has come about is the AD bank will simply tell you that if it is a payment against purchase of goods, I need to have absolutely clear documentation mandated by RBI, including a bill of entry. Now, you are talking of a situation where we are doing year-end transfer pricing adjustments, and these are upward or downward adjustment. The example that you are taking is the example of a downward transfer pricing adjustment, wherein you have earned 20%, 25%, but the group is asking you to go down to 10% and therefore adjust the cost of goods upwards. Now, this is something which is a practical problem that across industry being faced, because AD Bank plainly refuses to make that transfer pricing adjustment based payment at the year end because of the lack of documentation and largely being lack of bill of entry. And that is where I think increasingly it is a matter of waking up to the fact that when you are pricing your products, do not leave a situation to arrive at an year-end profit of 20 to 25%. The pricing of the product should be in such a manner that not only it meets the arm's length criteria from a transfer pricing standpoint. You raised a customs challenge also. Customs has equivalent valuation rules in the CVR, which find merit, some kind of a merit with the way the transfer pricing has demonstrated the transfer pricing methods. And the solution lies in operating at the border case at 8%, 10%, 12% margin, and at the year end avoid making any transfer pricing adjustment, because a downward TP adjustment continues to remain a challenge from a regulatory standpoint in India. Obviously, upward transfer pricing adjustment, whenever you are falling short of the margin, you can always get money, everybody is happy. But paying out at the year end, it's not that you cannot pay out. As Maulik mentioned, if you have the transfer pricing documentation supporting a TP adjustment, if you have an intercompany agreement supporting a TP adjustment, if your SVB order also says that you can do a TP adjustment, if all the documentation is speaking the same language, we have seen live cases where the AD bank, after internal licensing with the RBI, approves those payments. In case of services, it is much easier. The primary problem lies in import of goods.
In case of services, I have spoken to bankers, so they just inform me that you are making some services payment, it is a dividend. Virtually, it is
Your documentation has to speak. I think we'll keep it for the coffee table. Yeah. But yes.
The withholding tax applicability will depend upon the nature of the
absolutely. Absolutely.
So that's how the banker is not able to.
And you can't have a win-win situation. I think Rajneesh has given you a clue that it should be done during the period so that you don't have this issue at the end. If you treat it as services, yes, it could be the tedious issue. So I think we'll run out of time, but we'll still get into a couple of questions in terms of transfer pricing, because that's one part of it. One more question that Rajneesh is troubling, should be troubling people who are talking about these transfer pricing is in terms of when we have an ECB from my parent company given to me, the loans given to a subsidiary company. Earlier we were benchmarking possibly with the LIBOR plus. Now we all know LIBOR is since 31st December no longer 21, no longer a recognized a benchmark. We have the US in a separate way, the Euro, the SI4. How do we now look at, and there has been no amendment or a word from the tax department given in safe harbor rule, there is a LIBOR plus given. How do we now look at adjusting or benchmarking, as we call, for what were earlier benchmarked as a LIBOR plus, even in safe harbor? How do we look at that? Rajneesh, to you and then Maulik.
I think it's been long known and it was announced much in advance as the phasing out of LIBOR. And even RBI came up with this guidance in sometime around July of 2021 as to how the banks need to replace LIBOR in their dealings. I was reading somewhere the LIBOR linked contracts globally are substantially higher than even the entire GDP of US, and that is the kind of weight that LIBOR carried across global contracts. But over a period of time, very strong recommendations that have been coming about from a regulator like RBI, as well as when we do transfer pricing benchmarking analysis, we are trying to adopt those alternate approaches. So for example, if the LIBOR is phasing out, and LIBOR I think was publishing at least in 5 currencies so far, US, GBP, EUR, JPY and CHF. So from that perspective, we are looking at identifying alternate reference rates. For example, SOFR is present in US, and SOFR has been published since mid of 2018. So by far it's been more than 4 years that SOFR is running, and there are several and enough third-party comparable agreements into play, and the data trends are into play, that adequately takes into account the need for replacement of LIBOR. While obviously the industry will continue to keep dealing with variations such as LIBOR took into account the risk premium, whereas SOFR is risk-free rate, and therefore the spread for any lending, that is most important element in any lending, has to be taken into account. Or another example, LIBOR was always unsecured, whereas there are certain RFRs, risk-free rates, which are secured, and therefore between secured and unsecured, the difference has to be brought about when you are taking care of the benchmarking from a transfer pricing standpoint. So I think when you are moving from LIBOR to alternate reference rates, and depending upon the currency in which you are taking the ECB or the foreign currency loan, these are the factors which will play a very important role, and they have to be balanced when we are carrying out these benchmarks for TP analysis. And obviously the regulator like RBI plays a very important role in terms of the guidance came about in July 21.
Yeah. Maulik, I'll ask you, then we'll have one last question.
No, nothing further to add.
Okay, great. Because we've already overrun our time, maybe we'll have we had a case study, but I think we'll skip that. But one question now that we've had a lot of discussion will be now easy landing for everybody. And it's on the APA, because we've had the litigation mitigation, as we call, measures that are available in India in the tax, which is safe harbor rules, where we have also the map for the 2 countries and jurisdictions. We used to have AR, now APA. APA post-COVID has been slow. I have this data which says there has been only 62 APAs in 21-22, 13 being bilateral, 49 being unilateral, and 700 APAs are pending. Rajneesh, what has been your view in terms of APA? And I think that will be the last. Ashish, we may not have time for a case study, but I think we've had a very interesting session, because we were not sure whether we'll have questions, and we said we'll reserve 15 minutes, but we have had a great interaction. So I'll just bounce off the last one and then conclude APA for you, Rajneesh.
Yeah, I think I'll keep it short. APA is something which started with a bang, found very attractive attention from across industry. More than 50% participation came in from service industry, but APA saw all kind of complex transactions, including financing transactions that we just discussed, guarantees, contract manufacturing, LRDs, implementation of BERI, which is hard to come by in the Indian context. So while APA has seen it all from a government machinery standpoint, from the APA office bandwidth standpoint, I think the taxpayers have been facing certain challenges, as Vidur, you mentioned that 700 plus cases pending. The filings have been happening regularly, but resolving the APAs both on the bilateral and unilateral front is something which has gone slow, primarily because of the bandwidth available with the revenue. While we always see, observe and discuss in the department corridors that they are always working on refilling resources, they are bringing in the relevant experts who have spent enough time in transfer pricing and international tax divisions of department into the APA. Secondments happen, additional charges happen, deputations do happen. But still, I think the pace with which the taxpayers are expecting the APA process to move is something which is yet to be seen. We do have instances where there is already a good experience lying in the APA office, especially in the IT, ITS kind of situations, where they have already signed more than 300 APAs in the service industry. Those still tend to move faster compared to the other nature of transactions. But ultimately, it is a matter of a constant persuasion with the APA offices across 3 jurisdictions, Delhi, Mumbai and Bangalore, depending upon where your case is. But overall, yes, the expectation is that APAs as a solution, long-term solution to the taxpayers' dispute with the revenue, have to buck up and move at a much faster pace.
Your last words, Maulik, or we just conclude?
No, I think Rajesh mentioned it. The speed is kind of what is most important. The 700 you mentioned are already lying on. If I want to consider an APA, mine will be 700 first. I don't want to kind of block this thing unless the issue is very complex or there's a lot of kind of uncertainty around it. So I think we need more pace from the government on the APA to start concluding. And maybe government can clarify certain transactions. People should not come cost plus, etc. if they don't have the resources to kind of deal with those kind of situations.
Thank you. Pushpender, last word from the industry, and then we'll conclude.
On that management fees, corporate cost recharge, typically known on that, I just wanted to comment.
Please.
I have seen the 360-degree, from outbound or inbound. From inbound perspective, the authorities, Rajneesh rightly mentioned that revenue authorities have graduated and they really look into the documents and the substance. Like corporate setting overseas, why would they require to run your business when you have duplicating staff here? You have HR head here, you have admin head here, you have CFO here, and all those for all practical purpose you have all paraphernalia here. Why would you pay money back to corporate office sitting overseas? So there they'll get into the calculation. They also look into the qualification of the person whose cost is being pushed in. So all those working and details one should be keeping eye with, and then only they'll allow you. And the outbound side, when Indian headquartered companies pushing the cost outside, then their concern is why only 10%, why not 15? And on that side it should be zero rated. So I have seen 360-degree. But the bottom line is you should have the calculation at your tips. What is the basis? Because it's long running Excel, 5% markup typically on employment related stuff. But Rajneesh rightly mentioned, shouldn't be a stewardship services, which otherwise the senior folks, CXOs are supposed to do, overseeing function, but actually thing. So if we can have the catch up of those things, then we can substantiate the claim and have a good chance.
Thank you, Pushpender, at coffee. I must thank Pushpender, you from the industry's perspective, Rajneesh and Maulik from the professional perspective. I did throw a lot of bouncers and yorkers, and we had a couple of googlies coming in from the audience. But Ashish, I must compliment the audience, both virtual who were there. It's a great mode of having a hybrid mode. And I'm glad that we had this conversation. It was both ways, and we did manage to try to conclude it in time, but it went on because it was interesting. We didn't know whether we'll have question answers kept later, but I think it was nice to have it, and thank you so much for participating here. Thank you.
Thanks, Vidur, and I must say, I think break timings can always be managed, but if there are interactions, we prefer being inside the hall and address the queries, and that's the key objective that we keep in mind whenever we plan any such session. And I'm short of words to thank the panel. I would just want to say, 80 plus years of collective experience on this side of the hall, and the questions from the professionals on the other side made this session worthwhile and a good kickstart of the event. Thanks to Vidur sir, Maulik, Pushpender, Rajneesh for taking out time and being here with us. I want to thank you once again.
Thank you. Thank you all.
Small digital evidence of your presence at the event.
Oh, okay.
Vidur sir.
Oh, we need you have a photograph here too? Yes. Thank you.
So my only request is if we could take a quick short break, say about 15 minutes, and we want to start the faceless assessments panel discussion. It's 12:05, maybe about 12:20 if that works with all. So I'll take silence as yes. Thanks.